So thanks for taking the time, Matt. Which sectors are showing the biggest bounce back, and the reverse positive actions, and how sustainable is this trend?
Sure. Well, the subsequent positive rating actions have really focused on the auto sector, and to a lesser extent on the technology and the home building sectors. Yet the auto sector stands out. It's had the largest number of rating outlooks back to stable from negative for Toyota, Honda, Hyundai, Gear, and China Grand Automotive. They're all reporting, a strong recovery based on their, what we're seeing in their latest sales for the first quarter. But in China, they're as well, generally speaking, their relatively successful containment of the pandemic in the second half of last year has allowed economic activity to return to normal. So property sales have rebounded strongly, and we're seeing a positive knock-on effect to other sectors, including the construction and the engineering sectors. In Indonesia, we expect a bounce back in those sectors that were heavily hit by the pandemic, property, construction, and mining. But this will be partly driven by the Indonesian government's effort to stimulate growth. Now, our negative outlook with India, which is beset by a devastating second wave of COVID-19 infections, points to lingering downside risks for the 9 corporate entities whose ratings we have in India, whose ratings are either linked to the sovereign or their foreign currency ratings are constrained by India's country ceiling. So a prolonged outbreak, and if things continue to deteriorate in India, obviously will be disruptive to the operations of other Indian corporates that we rate as well. So again, it depends on the dynamics of the pandemic as to how things will go going forward.
Right. So, like you said, this trend is very difficult to predict. But the fact remains that, despite the number of positive actions, there are still a lot of negative rating actions continuing. Why is that happening? And what is the single biggest factor driving this negative trajectory?
So, for example, although there's been a recovery in the home building sector, it's a tale of two different, the investment grade versus the low single B and below rated companies. So lower rated Chinese home builders are still facing liquidity issues. And we've downgraded recently China Fortune Land, User Group Holdings Company, Golden Tiandi Holdings Company as well. And then in China, we've downgraded Red Star McAllen Group Corporation, China's largest owner and operator of home improvement, retail malls. So this is an example of bricks and mortar retail suffering at the expense of growing online retail. And then in India, we recently downgraded a retail company, Future Retail Limited, to restricted default when, as the resurgence of the coronavirus in India and the company's poor access to credit made things difficult for the company.
And central banks across the world have been, cutting interest rates, unleashing all kinds of monetary support measures, and of course we've seen the pile of negative yielding bonds rising. So how are corporates in the region reacting to these low interest rate environment? Are they using these low rates to sort of do liability management? That is. We're seeing every day corporates buying back their bonds and sort of replacing it with a cheaper debt, or are they loading up more debt because they see sort of more prospects for? So is there a risk of leverage going up in the region? What's the sort of the story here?
Well, I think there's a lot of refinancing going on right now to lock in at lower rates. The corporates are aware that these low interest rates are not going to last forever. And aside from rising US dollar rates, conditions are tightening in some domestic markets, including China. For other countries, the loose monetary policy will prevail as as COVID support, stimulus recovery measures are in play by the government. But that too cannot defy, rising US rates forever. So it's, they know that they're locking in the low rates at the moment. Seems to be their general strategy. But as to what they're doing with this, rather than loading up on debt, on extra debt, we're seeing it rather as liability management, early refinancing of their loans, conducting buybacks. M&A related debt is happening, but there's no general loading up on debt like we see in countries outside of APAC, for example, in the case of certain US corporate sectors where it's happening at the moment, such as the airline sector. The rise in leverage, if it were to happen, will more likely relate to the other side of the equation. In other words, underlying a bad operating performance, so continued COVID impact in some markets, for example, and continuing market sector changes, they lose market share, deteriorating profitability. So rather than an increase in debt, it would be more operating, a reduced level of operating cash flow that would cause leverage to rise.